Hey everyone, welcome back to Corporate Dakota, the place where we unravel the hidden stories inside company reports. And in this latest filing from Fidelity Capital Trust, we have quite a tale to tell about their numerous funds and their performance over the last year. Let's dive deep into the numbers and see what is really going on behind the scenes, because this report is packed with more than just financial jargon there is. A story of market ups and downs, strategic shifts, and even a few surprising investment choices. So before we dive in, if you appreciate getting straightforward insights from these official documents, make sure you are subscribed. We've also got a fantastic community over on our Discord server linked in the description below, where we break down even more corporate juicy bits and discuss them together. Alright, so what we have here is a certified shareholder report from Fidelity Capital Trust, filed for the period ending the 31st of October 2025. This is essentially an annual checkup on a whole bunch of funds managed by Fidelity, specifically focusing on how they performed, what they invested in, and of course how much it cost us investors. This report gives us a peek into the financial health and investment strategies of several Fidelity funds. But what is really interesting is how they're performing against the market benchmarks and what factors push their returns up or down, especially the ones that might not be obvious at first glance. Let's start with the cost for a hypothetical $10,000 investment. The Fidelity Stock Selector Small Cap Fund, for example, cost us around $89, which works out to about 0.85% of that investment for the year. Now, this might seem small, but remember, these are fund costs, not the prices of the stocks themselves, and over time, these small fees can add up. The report paints a picture of a strong market for US stocks in the 12 months leading up to October 2025, thanks to solid company profits, a tough economy dodging recession, and the Federal Reserve even cutting interest rates for the first time since late 2024. The S&P 500 index did very well, extending a really fast rebound that started in April of 2020. However, for some of these funds, like the Fidelity Stock Selector Small Cap Fund, it seems picking the right individual stocks was a bit of a challenge, especially in information technology, where their stock picks in software and services really hurt their overall performance. They also saw issues in industrials, particularly in capital goods and in healthcare within pharmaceuticals. And biotech, this is a classic example of how a strong market doesn't always mean every fund manager ails it. Now, for the juicy details, the biggest single miss for the fund was not owning Bloom Energy, a company that was part of their benchmark index, which saw an absolutely massive gain of nearly 1277%. Imagine missing out on a stock that grows that much. Yikes. They also missed out on Credo Technology, which gained 398%, and had an awkward position in Simply Good Foods, which actually lost 42%, and they increased their stake in this period. That sounds like a strategic misstep right there. But it wasn't all bad news. The biggest win came from picking stocks in the financial sector. Specifically in financial services, real estate also boosted their performance thanks to smart stock picks and being underweight in that sector. And surprisingly, they had an overweight in industrials, particularly in capital goods, which also lifted their relative performance. The shining star for performance was ICE Holdings with an 80% gain, and it was also the fund's largest holding. Mr. Cooper Group also contributed 146% upside, though it was not held at period end, and get this, a stock they held that wasn't even in the benchmark scene, it gained 199% and significantly helped their results. Now let's look at the long tail of performance over 10 years from October 2015 to October 2025, an initial investment of $10,000 in the Fidelity Stock Selector Small Cap Fund grew to $28,445. That is a decent return, but the Russell 2000 index turned that same $10,000 into $24,471, and the broader Russell 3000 index grew it to a whopping $37,343. Looking at the 1 year and 5 year returns, the fund actually did pretty well, especially in the 5 year mark, showing 14% average annual returns, beating the Russell 2000 index. So there is some consistency there. As of the 31st of October 2025, the fund size was over $5.4 billion with 230 holdings and a portfolio turnover of 46%. This means they are actively managing the portfolio. Where did the money go? Market sectors show industrials at 19.8%, healthcare and financials both at 17.1%, and information technology at 14.6%. This diversification suggests a strategy that doesn't put all its eggs in one basket. Geographically, 87.9% of the fund's assets are in the United States, with Canada coming in second at 4.2%. Thailand is also notable at 1.7%, which is an interesting choice. The top holdings show ICE Holdings at 2.0%, Fabrinet at 1.7%, and Advanced Energy Industries at 1.6%. These are the companies driving the fund's performance right now. Now, this report also details different share classes for these funds. For example, the Fidelity Advisor Stock Selector Small Cap Fund Class Z has a slightly lower cost at $77 a year for a $10,000 investment, or 0.73%. The performance narrative is identical to the first fund because it is the same underlying manager and strategy, which makes sense. For Class C, we see a life of fund performance from February 2017 to October 2025. A $10,000 investment grew to $22,954. The Russell 2000 index for the same period yielded $17,915, and the Russell 3000 index saw it grow to $27,318. So there is a clear outperformance by the fund over its life compared to the small cap index. At least historically, the 5-year returns are also strong at 14% annually. Moving on to the Fidelity Capital Appreciation Fund FDCX, their costs are a bit higher at $69 for a $10,000 investment. That is 0.63%. The performance narrative is quite similar to the stock selector fund, mentioning strong US stock gains and the Federal Reserve's interest rate reductions. But here's where it gets interesting. The key detractor against the S&P 500 index was market selection, specifically an underweight in information technology and an overweight trade in healthcare. Also hurt them. That is a bit of a reversal from the small cap fund analysis. The biggest individual detractor was an underweight in Broadcom, which gained 120%. So they missed out on a big winner there, avoiding Tesla, a benchmark component that gained 83% was another miss, and an overweight in United Health Group, which lost 38%, also hurt them. It seems like they made some bold moves that didn't quite pay off this year. Looking at the 10-year cumulative performance for the Capital Appreciation Fund, an initial $10,000 grew to $38,686, which is quite good, slightly beating the S&P 500 index's $39,196. Return it as a close race over that decade. This fund is massive at over $7.2 billion with 144 holdings and a portfolio turnover of 84%. This suggests a more active approach to managing this fund. The market sector breakdown shows a heavy tilt towards information technology at 32.7%, then financials at 17.3%, and industrials at 13.5%. This focus on tech and financials is a key strategy differentiator compared to the small cap fund. Geographically, the US dominates at 88.9%, but Taiwan at 2.5% and Canada at 3.1% show some international exposure. And the top holdings are no surprise: Nvidia Corp at 9.4%, Microsoft Corp at 7.1%, and Amazon.com at 6.4%. These tech giants are clearly the engine driving this fund's recent performance. Now let's look at the Fidelity Disciplined Equity Fund FDX. This fund costs about $74 for a $10,000 investment, or 0.66%. The performance narrative again mirrors the market sentiment of a strong US stock performance supported by economic resilience and Fed rate cuts. Interestingly, for this fund, security selection was actually a positive contributor to performance against the S&P 500 index. Led by their choices in industrials, healthcare was an underweight position, which helped, and communication services were also a strong area. This shows a different strategic approach with different successes compared to the other funds. But even here, they had detractors. Not owning Tesla, a stock that gained 83%, was a big miss. Their stake in United Health Group, which lost 35%, was another detractor, and they significantly reduced their position in that stock this period. They also had an underweight in Palantir Technologies, which gained a massive 382%. So that is another big miss in stock picking. Over the past 10 years, an initial $10,000 investment in the Disciplined Equity Fund grew to $35,549, performing slightly better than the S&P 500 index's $39,196 return. However, it lagged behind the S&P 500 index slightly over that period, giving back some ground in the last 2 years. This fund is smaller at about $2.2 billion, holding 114 securities, with a portfolio turnover of 53%, indicating a moderate management style. The sector breakdown shows a strong concentration in information technology at 35.7%, industrials at 15.9%, and communication services at 13.2%. This tech-heavy focus aligns with some of the other funds, but the specific allocation differs. Geographically, this fund is overwhelmingly US-focused at 99.0%, with very little international exposure. Unsurprisingly, Nvidia Corp is the top holding at 10.4%, followed by Microsoft Corp at 8.1% and Amazon.com at 5.3%. These are the big tech names that dominate the information technology sector and are clearly driving this fund's performance. Now, for my take on these filings, it is clear that Fidelity is managing a diverse set of funds each. With its own strategy and performance story, the stock selector small cap fund seems to be navigating the choppy waters of individual stock picking with some successes and some misses. but its long-term performance is solid. The Capital Appreciation Fund shows strength in its tech and financial focus, and its long-term numbers are impressive. The Disciplined Equity Fund demonstrates a more active management style with some bold bets that paid off in certain areas, but also led to some notable misses. The company itself shows consistent management and reporting, likely benefiting from its scale and experience. When we look at the financials, the consistent factor across these reports is the market's strong performance over the last year, which benefited most funds. However, the nuances in security selection and market timing reveal the Inc. strategies at play. The key takeaway is that while the overall market was favorable, individual fund performance varied significantly based on the manager's choices. The risks mentioned are standard for the industry, including market fluctuations and counterparty risk. But the sheer concentration in particular sectors like information technology for some funds does warrant attention. What is really interesting is seeing how different classes within the same fund family, like Class A, Class C and Class Z, have different cost structures and therefore different net returns, even though the underlying investment strategy is the same. These reports highlight the importance of understanding those class differences to maximize your investment experience. Looking ahead, the strategies employed seem geared towards growth and technology, which is a trend across the market, but also carries inherent volatility. The strong performance of tech Tats like Nvidia and Microsoft in the top holdings of several funds underscores this trend. The company's commitment to reinvesting in services should also be a positive for long-term shareholders. Overall, Fidelity appears to be navigating a complex market with a mix of successes and challenges. The sheer volume of data here is a testament to the complexity of fund management and the detailed reporting required, but by focusing on the key performance drivers, the sector allocations, and the top holdings, we can start to decode what is truly happening within these investment strategies. Alright, that is our deep dive into these Fidelity Fund reports. What is your take on their performance and strategies? Let us know your thoughts in the comments below. Did you find these insights valuable? Then please hit that like button and subscribe for more corporate decoding sessions. And don't forget to join our Discord community, linked in the description, for even more discussions and analysis. Thanks for watching, and we'll see you in the next one.